What if the global economy was a giant milkshake and the US dollar a powerful straw, sucking in capital from every corner of the globe? Welcome to the world of the Dollar Milkshake Theory, a concept that might redefine your understanding of global finance. In an era of shifting economic tides, understanding the Dollar Milkshake Theory is crucial. This theory, conceived by financial analyst Brent Johnson, paints a vivid picture of how the US dollar stands to dominate global economics, despite the country's rising debt and inflation. Here's how it works. Picture you're at a party, and there's a milkshake blending contest. Each participant, representing a different country, brings their own unique ingredients to contribute to this collective milkshake. These ingredients could be anything from strawberries and bananas to a dash of chocolate or a sprinkle of cinnamon. Just as countries contribute their resources, cultures, and technologies to the global economic mix. Now visualize the blender, whirring away, mixing all these distinct elements into one delectable milkshake. That's our global economy, a blend of different economies and resources, creating a whole that's greater than the sum of its parts. But here's the twist. What if one participant, let's say he's representing the US, decides to grab the biggest straw and starts to drink everyone else's milkshake? What would that mean for the rest of the partygoers? That's where the Dollar Milkshake Theory comes in. So what is this Dollar Milkshake Theory, you might be asking? Well, sit back, grab a milkshake if you have one, and let's unravel this economic enigma together. The Dollar Milkshake Theory is a metaphorical concept coined by Brent Johnson, CEO of Santiago Capital. It proposes a scenario where the United States, like a thirsty patron at a party, is going to suck up the world's capital, much like drinking a milkshake. But why? How does the US dollar manage to maintain its dominance amidst America's ballooning debt? We'll dissect these paradoxes and more. Why the US, you ask? Well, it's because of the dollar's status as the world's reserve currency. This unique position allows the US to draw capital towards it, especially in times of global economic uncertainty. That's when investors typically flock to the perceived safety of dollar assets, further strengthening the US's position. The US will attract global capital, effectively drinking the world's liquidity through its straw, the strong dollar. But what does this mean for international markets and currencies? This theory isn't just about the US's economic might. It also explores the potential implications for the global economy. If the Dollar Milkshake Theory proves true, countries heavily reliant on dollar funding could find themselves parched, struggling for capital. It's like when you've been sipping on a milkshake, and suddenly there's nothing left but air and disappointment. This could potentially lead to a global economic imbalance, with the US enjoying a capital inflow at the expense of other nations. It's like the US getting the lion's share of the milkshake, while the rest of the world is left with the melted remnants. That's the Dollar Milkshake Theory in a nutshell. But you're probably wondering, but how does this theory work? Let's dive deeper. And dive deeper we will, into the mechanics of this theory, the implications, the criticisms, and what it could mean for the future of our global economy. Because after all, who doesn't love a good milkshake story? Especially when it could shake up the world as we know it. How does one country, even as powerful as the US, drink up the world's capital? It's a fascinating question, isn't it? To understand the mechanics of the Dollar Milkshake Theory, we need to take a closer look at three key components: the US dollar, interest rates, and global capital flow. Let's start with the US dollar. As the world's reserve currency, meaning that it is used by central banks and governments worldwide to hold their foreign exchange reserves, the dollar is like a magnet for global capital. It's the currency of choice for international trade, and when economic conditions get rocky, investors often flock to the dollar for its perceived stability. This consistent demand for dollars helps to keep its value high. Next up, interest rates. When the US raises its interest rates, it's like adding a cherry on top of our metaphorical milkshake. Higher interest rates make dollar-denominated assets more attractive, pulling in capital from around the globe. Think of it like this. If you had the choice between two savings accounts, one offering a higher interest rate than the other, which would you choose? The one with the higher rate, of course. Now apply that logic on a global scale. Finally, let's talk about global capital flow. In our increasingly interconnected world, money can move across borders with a few clicks of a button. Capital naturally flows where it can get the best return, and with a strong dollar and higher interest rates, the US often provides the most enticing option. The Dollar Milkshake Theory suggests that these three factors together, a strong dollar, high interest rates, and easy capital flow, create a kind of financial straw that the US can use to drink up global capital. It's a powerful image, isn't it? A single country sipping up the world's wealth like a delicious milkshake. So, the US has the straw. But what does this mean for the rest of the world? Well, that's a question with some serious implications. Imagine being at a party and watching as one person drinks up all the milkshake. Not a pretty sight, right? Now let's translate this to the global economic stage, where the milkshake is the world's capital, and the person doing all the drinking is the United States. This is the essence of the dollar milkshake theory, and it has some pretty far-reaching implications. First off, let's talk about economic instability. The theory posits that as the US sucks up global capital, other economies may be left high and dry. Just like the partygoer left without a sip of milkshake, countries with less robust economies could find themselves in a precarious position. This could lead to economic downturns and even crises in these countries as their capital dries up and they struggle to maintain economic growth. Next, there's the issue of currency fluctuations. With the US dollar becoming the go-to currency for global investors, other currencies may find themselves devalued. This could lead to exchange rate instability, creating a ripple effect that impacts global trade. Imagine trying to conduct business when the value of your currency is constantly changing. It's like trying to hit a moving target. Lastly, the theory suggests a potential for crises. With the US consuming so much of the world's capital, it could lead to a situation where there's simply not enough to go around. This could trigger a global financial crisis, similar to the one we saw in 2008. So it's clear that the dollar milkshake theory paints a picture of a future filled with economic instability, currency fluctuations, and the potential for crises. It's a sobering thought, and one that has many economists and policymakers around the world paying close attention. But is this theory foolproof, or are there potential counter-arguments? Well, no theory is without its critics. Some argue that the dollar milkshake theory oversimplifies complex economic systems. Let's delve into these counterpoints, exploring alternate viewpoints and predictions. Like any economic theory, the dollar milkshake theory has its critics. And justly so, as no theory is perfect, and the world of economics is a constant dance of adaptation and change. The first criticism often leveraged against the dollar milkshake theory is the potential for other countries to resist the pull of the almighty dollar. Think of it as a game of tug-of-war. On one side, we have the dollar flexing its muscles. On the other side, we have the rest of the world's currencies, digging their heels in and refusing to be pulled into the dollar's vortex. Critics argue that these countries could implement measures to insulate their economies from the dollar's gravitational pull, thus weakening the theory's validity. Another major counter-argument is the possibility of a new global currency emerging. Yes, in our current landscape, the dollar rules supreme. But who's to say that won't change? After all, empires rise and fall, and currencies are no different. The rise of cryptocurrencies and digital currencies backed by central banks are prime examples of this. These new forms of currency could potentially disrupt the dollar's dominance, adding a twist to the dollar milkshake theory. Some also question the ability of the US economy to absorb the influx of global capital without experiencing significant inflation. If the US can't manage this capital influx effectively, the theory might turn into a dollar milkshake mess, rather than a neatly blended concoction. Lastly, critics point out that the theory heavily relies on the presumption that the US will continue its aggressive monetary policy. But what if the US decides to shift gears? Policy changes can have profound effects on economic theories, and the dollar milkshake theory is no exception. So, is the dollar milkshake theory the ultimate fate of our global economy, or just another theory in the economic world? Well, as with any theory, only time will tell. But until then, we'll keep our eyes on the dollar, the milkshake, and the ever-evolving dance of global economics. Theories aside, the future of the global economy is always uncertain. As we stand on the cusp of the unknown, we're reminded of the myriad factors that could influence the trajectory of our collective economic journey. Let's consider political decisions, for instance. Policy shifts can have far-reaching implications on the global economy. Whether it's trade agreements, changes in tax laws, or the introduction of economic sanctions, the impact of such decisions can ripple through the global economy like a stone tossed into a pond. Next, there's the ever-evolving realm of technological advancements. From the rise of artificial intelligence to the advent of blockchain technology, the innovations of today could very well shape the economic landscape of tomorrow. They have the potential to disrupt traditional business models, create new industries, and even redefine the concept of work. The dollar milkshake theory presents a fascinating lens through which to view the evolving relationship between the US dollar and cryptocurrencies, particularly Bitcoin. As the US intensifies its absorption of global capital, a ripple effect could ripple through the investment world, potentially catalyzing a shift towards alternative assets like Bitcoin. Investors, in an effort to diversify their portfolios and safeguard their wealth against the erosion of currency value, might increasingly turn to cryptocurrencies. This intersection of the dollar milkshake theory with the realm of digital currencies suggests that a stronger US dollar could inadvertently boost the appeal of cryptocurrencies. As traditional investment landscapes become more aligned with the dollar, the unique attributes of Bitcoin and its counterparts, such as their inflation-resistant nature and detachment from traditional currency devaluations, become more pronounced. In this scenario, the burgeoning interest in cryptocurrencies could amplify their market value, setting off a self-reinforcing cycle that bolsters the stature of these digital assets even further. However, the interplay between the dollar milkshake theory and the trajectory of cryptocurrencies like Bitcoin is intricate, influenced by a myriad of factors. This perspective offers a thought-provoking angle to consider as we explore the future trajectory of digital currencies in an interconnected global economy. And then, societal changes. Changes in human behavior and societal norms can also be powerful drivers of economic change. The rise of the gig economy, the shift towards renewable energy, the push for greater equality and inclusivity, these are all societal shifts that have the potential to reshape the global economy in profound ways. In the face of such complexity and uncertainty, theories like the dollar milkshake theory can serve as helpful frameworks for understanding the potential dynamics at play. But, as with all theories, they're not crystal balls. They can't predict the future with absolute certainty. What they can do, however, is offer us fresh perspectives and perhaps make the unpredictable a little less daunting. Theories can help us make sense of the changing world around us, and in doing so, enable us to navigate the future with a little more confidence and a little less fear. So, next time you're at a milkshake blending contest, remember the dollar milkshake theory. It might just give you a fresh perspective on the global economy. Understanding the dollar milkshake theory requires diving into the dynamics of global liquidity and central bank policies. Since 2008, central banks around the world have injected an astounding $30 trillion into the economy, creating a vast pool of liquidity akin to a milkshake. The shift in the Federal Reserve's approach, moving from an easing monetary policy to a tightening one, marked a significant turning point. This shift was akin to swapping out a syringe for a massive straw, drawing liquidity away from global markets. As a result, the US dollar strengthens against other currencies, exerting intense pressure on countries burdened with debts in dollars. For these nations, the cost of servicing their debt skyrockets. This tightening of liquidity has a ripple effect. Companies and governments outside the US find themselves grappling with heightened credit risks. Their ability to fulfill foreign debts, particularly those in US dollars, diminishes. This situation heightens investor anxiety, often leading to capital flight from these countries. Understanding this theory helps in comprehending the complex interplay of global financial policies and their impact on international economies. The key takeaway is the projection of a continually strengthening US dollar. This theory hinges on the persistent global demand for the dollar, positioning it as a dominant force in the international monetary landscape. While opinions vary on the validity of this theory, its implications on the future trajectory of the US dollar and the broader global economy cannot be ignored. Moreover, the theory also casts a spotlight on the potential effects it could have on the valuation of digital currencies, including Bitcoin. The role of central banks is pivotal in this context, as their monetary policies significantly influence the unfolding of this theory and its consequent effects on worldwide economic dynamics. But whether you're a staunch supporter or a skeptical critic, the dollar milkshake theory certainly gives us food, or should I say drink, for thought. Remember, economics isn't just about numbers and charts, it's also about understanding the world around us. And sometimes it can be as simple as a milkshake.